Hello and welcome back to another Camtasia video lecture dealing with Chapter 5. In Chapter 5 we've been talking about CVP analysis. In this video we're going to see how do we determine a break-even point. And hopefully you remember from a previous video we said that the break-even point is where profit equals zero. Okay, meaning we cover all our expenses. We covered our variable expenses, covered our fixed expenses. We just don't have any profit. Net profit or net operating income is zero. So the first thing that we need to really understand here is that there are two ways or two methods that we can use to calculate break-even points. We can use the equation or we can use the formula method. We can calculate break-even points both for unit sales as well as dollar sales. So let's run through an example and see exactly how do we calculate the break-even point. So the first method we have here, is the equation method. Okay, we're going to use that simple equation that we learned in, I think it was video 2, that was profit equals unit contribution margin times quantity minus fixed expenses. In this case, we have to set our profit equal to 0 because remember, the break-even point says cover all our expenses, just don't have any net operating income. So let's suppose for a minute that RBC wants to know how many bikes must be sold in order to break even. And again, that means that the profit, or we'll talk about target profit here in a second, but the break-even point or break-even point is where we earn a target profit of 0. Okay, so in the slide here we see the equation method. Again, can be used, doesn't have to be. We can use the formula method, which we'll see next. So shouldn't be a really big surprise here. The break-even point is 400 units, right? We've seen this in previous videos. The takeaway from this here really is recognizing that we're using the equation method, but we're setting that profit equal to 0. Okay, so if we have a single product situation where we're only making big pens, that's all we're making. We're not making big pencils. We're just making pens. We can use this equation method for computing how many units we need to sell again to break even. We can also use the formula method. Right now, the formula method is a nice little shortcut version of the equation method. It centers on the idea that we talked about earlier in the chapter, that each unit provides a certain amount of contribution margin that goes towards covering those fixed expenses. Okay, very important that you understand or be able to recall that idea that when we sell a unit, or each unit that we sell provides a certain amount of contribution margin that is going to cover our fixed expenses, or that's going to go towards covering those fixed expenses, as well as hopefully provide net operating income for us. But since we're looking at the break-even point, remember, we want that net operating income to be 0. So how do we calculate the unit to break even? Very simple. Using the formula method, we take our fixed expenses and we divide it by our unit contribution margin. Okay, so if I were you, I'd kind of jot this down here, this little disclaimer, if you will. If we're looking for unit sales to break even, we have to divide by the unit contribution margin. Okay, what if we want to figure out the break-even point in sales dollars, meaning what does our sales volume need to be in order to have a profit of 0? Well, in this scenario, instead of looking for units, we're now looking for dollars. Guess what? We can also use the equation method, or we can use the formula method. Does not matter. So let's take a look at an example here. Here we have the equation method, okay? And when we're looking for a dollar amount, right? That dollar amount that we're looking for, that sales figure, we're always going to use the CM ratio. So I would jot that down too. We're looking for a dollar and break-even point, a sales dollar figure. We have to use the CM ratio. So how do we figure that out? Well, again, we use the same equation that we've seen previously. Profit equals CM ratio times sales minus our fixed expenses. Since we're looking for the break-even point, and again, not to sound redundant, what is the break-even point? Well, it is where our profit or our net operating income equals 0. So when we run the numbers using the CM ratio, we see that our sales volume has to be $200,000, or we have to sell $200,000 of product to get a target profit of 0 or to get a break-even point. We also have the formula method for calculating dollar sales and break-even, okay? If we're looking for dollar sales, what do I need to use? I need to use the CM ratio. So to figure out the dollar sales to the break-even point, I take my fixed expenses, and in this case, since I'm looking for dollars, I need to divide by the CM ratio. And I see that the dollar sales have to equal $2,000 in order for me to have a 0 profit, okay? When it comes to should you use the formula method or the equation method, personally, it really doesn't matter to me. You get the same answer regardless. Whichever method you feel more comfortable with, whichever method you like better, by all means use it to answer the question. Me personally, I'm a big fan of the formula methods because they're a little easier, little quicker to use, okay? What I want to do now is I want to continue on and look at how do we determine the level of sales that are needed to achieve a target profit, okay? Now, this is identical to the break-even point. The break-even point says our level of profit is 0. In these coming examples, we're going to say, okay, we want to sell enough to cover all our expenses and provide a profit or a net operating income of X. Okay, so let's look at a quick example or a couple examples here of target profit. Okay, so in target profit analysis, what we're doing here is estimating what sales volume is needed to achieve a specific target profit. We can compute this target profit both in the number of units that must be sold to attain a target profit using either the equation method or the formula method. Okay? So let's look at the equation method. The equation method is summarized here on the slide. Shouldn't be anything new, right? We've seen this before. However, our goal is to solve for the unknown Q. We don't know what our quantity is, okay? This quantity is going to represent the quantity of units that we have to sell in order to achieve a certain target profit. So let's run through the example, okay? Let's suppose that RBC wants to know what are the number of bikes? How many bikes must be sold to earn a target profit of $100,000, okay? So what that means is at the end of the day, we want to make sure our sales are enough not only to cover our variable and fixed expenses, but also provide a net operating income or a target profit of $100,000, okay? Here's the equation method. Remember, we're looking for Q. We don't know what our Q is. That's our unknown. So we set the profit equal to 100,000 equals the unit CM times the quantity minus our fixed expenses. We run the numbers and we see that our quantity is 900 units. Now, very important, since we're looking for a target profit in units, what am I using? I'm using the unit contribution margin, okay? Guess what? We can also use a formula method, right? The formula method that we see summarized here is what we use to compute, again, the quantity of units that have to be sold to attain a target profit. If you look at this, this should be very familiar to you. Because if we look at fixed expenses divided by contribution margin, or unit CM, that's our break-even point, okay? All we're doing here is saying, yeah, I want to know how many units I got to sell to get a target profit of a specific amount. So in order to figure that out, I need to take my target profit, in this case it's 100,000, add my fixed expenses, and divide by my contribution margin per unit, okay? So let's look at the example here. Let's suppose that RBC wants to know how many bikes it has to sell in order to earn a profit of $100,000. Same thing as what we saw before using the equation method. Well, the formula method, it's a little nicer, a little cleaner, a little easier to use. I'm going to take my target profit of 100,000 plus my fixed expenses of 80,000, divide by my unit CM, which is $200. I get a unit sales of 900 units. That means if I sell 900 units, I'm going to cover my increase in variable costs. I'm going to cover my total fixed expenses, and I'm going to have a profit of $100,000. Guess what? We can also, if we so choose, to compute the target profit in terms of sales dollars. We can use either the equation method or the formula method. Does not matter. Let's look at the equation method. Now, again, this equation, nothing new. Profit equals CM ratio times sales minus fixed expenses. Keep in mind, because I'm looking for a target profit in sales dollars, I have to use the CM ratio. Cannot use unit contribution margin or contribution margin per unit. Because I'm looking for dollars, I have to use the CM ratio, okay? Same example here, right? We're still trying to figure out what is that profit. So we know we want a profit of $100,000. We know our CM ratio is 40%. Here we do not know what our sales volume is. That's what we're trying to figure out. That's our unknown, okay? And we see that in sales dollars, we have to have sales volume in dollars of $450,000 in order to break, or in order to achieve that target profit of $100,000, okay? Here is the formula method. Again, personally, huge fan of the formula method because it's easy to remember. It's easy to see how to do it, right? There's no algebra involved. You just add a couple numbers, divide by a number, boom, you're done, right? Again, when I am trying to determine the dollar sales to get a target profit, I must divide by the CM ratio, okay? Basically, to figure this out, I just take the break-even point, the sales dollars to attain a break-even point equation, and I just add target profit. That's all I do. Target profit plus fixed expenses divided by the CM ratio. I see that my sales dollars that I need to achieve a target profit of $100,000 has to be $450,000. No difference really between the equation method and the formula method. The answer is always going to be the same. We just have to know, am I calculating a break-even point or am I calculating a target profit? Am I looking for sales dollars or am I looking for units? That's really the main takeaway here. Okay, we'll do some examples when we get to the study guide portion of the lecture. Remember, in your video or in your study guide, I have you doing a couple exercises. We're going to walk through those together. I don't expect you to be able to do those on your own, but when the time comes, I do expect you to at least try it and see if you get the right answer. Then watch the video and make sure you got the right answer. So, real quick review of what we covered in this video. Remember, we're looking for break-even points, right? We're either looking for break-even or target profit. We said that regardless of what we're looking for, target profit or break-even analysis, we have two methods to use, the equation method or the formula method. I don't care which one you use. Whichever one you're more comfortable with, whichever one makes more sense to you, go with that one, okay? The real takeaway here, whether it's the equation method or the formula method, if you are looking for a break-even point in units, you got to use the unit contribution margin or the contribution margin per unit, okay? Same thing with if you're looking for the break-even point in sales dollars, you can use either method. I don't care which one you use, whichever one you like better. The only takeaway here is, regardless of which method you use, if you're looking for the break-even in sales dollars, got to use the CM ratio, okay? Then we looked at target profit, and we said that, target profit is just an expansion of the break-even point, right? Calculate and break-even point. Target profit, we can use either the equation method or the formula method, does not matter. Each method gives us the same answer. If we're looking for, or if we're using the equation method, looking for the target profit, remember our Q is unknown, so we're looking to solve for Q. If we're looking for the units, we have to use the unit CM or the contribution margin per unit. Same thing with the formula method. I just divide target profit plus fixed expenses, gives me my unit CM, or divided by the unit CM. Again, since I'm looking for unit sales, I know in my head, got to use the contribution margin per unit or the unit CM. Same thing for target profit, looking for sales dollars. The main takeaway here is, since I'm looking for sales dollars, got to use the CM ratio, okay? Same thing with the formula method, looking for dollars to attain a specific target profit. I need to take that target profit, add it to my fixed expenses, and again, divide by the CM ratio, okay? When we come back in our next video, we're going to talk about margin of safety, and we're also going to talk about the degree, we're going to talk about cost structures, excuse me. Okay, so tune back in for that video.